So as we normally do, we go through 3 topics of the day. Today I'm going to do a sort of a global recount of what we're thinking about. And also what the market really is paying attention to. That's why we have these sort of biweekly communications as to what our insights and observations are, or what we're paying attention to, and how we're navigating through markets. Because let's face it, there's constant headlines on majority. Doesn't matter what news channel you're tuning into. They're more negative than positive. They always have been, and they always will be, because negative sells. So what we really want to do is pay attention to where we are now, and more importantly, where we should be, and are we positioned correctly accordingly. And so hopefully this provides some context and some confidence as it relates to that, and how we see the overall market itself. That being said, today markets moved negatively. Last night we had St. Louis Fed Bullard gave a speech about he could see the Fed funds rate going from potentially 5% to maybe even 7%. That's really the terminal rate. It's the rate at which the Federal Reserve has their funds rate, their price of money, if you will, the cost of capital, the risk-free rate of return, and versus where inflation is. Now, keep in mind, we had 8 handle on inflation, and hopefully we saw PI come down, and the CPI hopefully is trending lower as well. It has to be. There's a lot of things out there from housing that we see just are grind to a standstill. And again, that's a large percentage of the GDP, a large percentage of the input towards basically inflation. But it takes time. It's a lag effect. In fact, it's a 1/12 number for the PPI, the CPI over time. So we see that window every month should be falling or turning over. But in the meantime, the Federal Reserve has to have that hawkish rhetoric. Now, Rob, why is that? It just seems like they're unrelenting. Well, keep in mind, the risk of a policy error is greater on the upside, meaning if they don't get ahead or bring the terminal rate, the Fed funds rate over where the inflation rate ultimately want it to be, and they want it to be sub 3%, around the 2% level. We'll see if they settle for 3%. I think they will, because they'll see inflation come down rapidly next year. But in the meantime, they can't afford a policy error, because they have tools to help the economy once it falls into recession. They have tools to help stimulate growth again, to be accommodative. They don't have tools. The only tool they have is to ratchet up rates super, super high if inflation does reverse, like it did in the 70s. That was the policy error that the Federal Reserve keeps talking about in the 70s. The Federal Reserve was ahead of inflation, and then they paused, right? That's why a lot of talk about a pause, a pivot. We hear that all the time, and it's in nauseum, but it's important. And the reason why is, in the 70s, the Federal Reserve thought they were winning the war, and they stopped too early in terms of being hawkish or raising that interest rate. That pause then caused inflation to actually spike even higher, 21.5% prime in the early 80s, and then Volcker. In fact, they had 3 Federal Reserve chairmen in the 70s. They finally had to get somebody who was super hawkish in the basically late 70s, early 80s to come in and squash inflation once and for all. The next 2 decades was off to the races. We got pro-growth policies. From 82 on, markets did really well, plus you got ahead of inflation. So it's important that we get through this right now. It's important that the Fed actually is successful in their mission critical job right now, and that's why we're seeing constant Fed speak. It's very expected, it's very anticipated. I would be shocked if they turned dovish moving forward. Signs of recession, yes, we have signs of recession all around us, and that's the concern moving forward. Now, earnings have been, without tech, if we take ex-tech, because they're laying off now for the most part and cost cutting as they should, earnings have been actually pretty good, pretty okay for the most part for the third quarter. The question is, moving forward, as consumers and small business owners feel signs of recession, there's a lot of holding in and battening down the hatches and not wanting to, or not willing to, actually overextend themselves and spend. So that's going to cause a slowdown in 2023. How do we know this? There's signs of a recession. Well, it's flashing on the yield curve. So the 2-10s, that means the 2-year yield is higher than the 10-year, or the 3-month is higher than the 10-year as well. And the 3-month is the one that you want to look at for an inflation. It's been a pretty good read historically speaking. So that's flashing red on the dashboard and has quite some time. The short end to the long end all across the yield curve is inverted. Again, it's another historical sign that a recession is on its way. Now, how deep the recession is, will it be an earnings recession, will it be a consumer recession, and will it actually really take down earnings for next year? Earnings, as we know, right now are about 230 on the S&P 500. So we could see it come down a little bit more as corporations guide down. Now, the S&P 500 is pricing around a 215. So again, the market level is lower than where the earnings are actually being guided. So that's where there's a disconnect between the actual price and the actual where the markets are. And that's the price discovery. That's the volatility. That's the price we pay as investors to basically, hey, listen, let's stick to our long-term game plan, know that we own quality businesses, getting paid while we have those dividends paying us and receiving the income, but also know that these are short-lived 18-month cycles. And once we get a bears die, we then see a resurgence of a new bull market. And bears really about 3 out of 3 years, and every 7 years you're about a bull 7-year run for a bull market. And so you're seeing that historically we're getting closer to sort of a washout, a flush out on the downside of the bear as the market tries to have price discovery. Where will the earnings actually ultimately end up? And who knows, if we got a first quarter or second quarter of next year washout, we could see that. But that'll be very rapid. And then there's a rebound. And from that point forward, we have a flush to sort of grinding our way higher to newer highs. In the meantime, what do I struggle with and what the market really struggles with? Well, here's where the market is. We had the bounce, which was completely unexpected. In fact, all of Wall Street in the month of October was caught off sides, and we're seeing signs of, the market still continuing to have some constructive, positive days, even though we have some days of give back, even in the months of November. But right now, the S&P 500 is at the level, as I tape this, about 39.49. That's today as we're trading. The 50-day moving average is 37.92, and the 200-day moving average is 69 right there. So we actually broke in the month of November, or October, November, we broke above the 50-day moving average, which is a very healthy, constructive sign, something you want to see if there's signs of markets moving from late stages bear to early stages bull. We don't know. We will know if when we see this S&P level get to the 200-day moving average. Again, just think about 4,000 level for the S&P 500. At which time, if we hit the 4,000 level, 4,000, let's call it 69 or 70, and we do not go higher, and we could see the markets trade down to another potential lower low. That's just how the bear market actually works. If we actually get to that level, and we have a couple trading days where we have a base, and then all of a sudden we break higher but close higher than this number, this 200 moving day average, that could be an extremely bullish sign, extremely positive sign. So we're sort of in the waiting pattern as we wait for earnings and guidance from corporations, and that's how all that's playing out. But what we struggle with, if we look at the last 5 to 6 weeks, everything that has gone right, basically we wrote down, and that's what the market has seen, a bounce, and we made a list, and here it is. So the midterms are behind us. We have some certainty. We know we have divided Congress. The Federal Reserve has leaked the word pivot in a headline, and then they had to retract that. Again, Bullard again, still maintaining his hawkish perspective, and a few other Federal Reserve speakers as well have been saying the same. Bank of Japan inverted the yen. This pushes yields higher and the dollar lower. The euro rallied hard, pushing again on the dollar down. The dollar is, once the dollar's bullish, that means that it's very negatively impactful for earnings and everything else here. The dollar has basically come down in the last few weeks, the US dollar that is. Inflation data has come in lighter than expected, as I reported, both in the CPI and the PPI. So that's another good specific thing that we're discussing. There's more dovish chatter. Again, that just reversed in the last 24 hours, as I just pointed out. But over the course of the last few weeks, we've seen some of that. The GDP was positive for the third quarter. Earnings outside of tech have been okay, as I discussed. Short-term interest rates have been crushed as shorts have basically been forced to cover. So there's a lot of short, as I said before, shorting in the market, betting that the market was going to go down, and we've seen a bounce in October and November because they have been betting that the market was going to go down on an institutional level. Bond yields leaked lower. They're up a little bit right now. And then China leaked that they basically said that they're going to entertain a more modest zero COVID policy, whatever that equates to. That's important. Why is that important? Because if China shuts down, which they're doing, they're shutting down the supply chain. The supply chain shutdown is causing those pressures through the marketplace because of a supply-demand issue of increasing inflation. And that's really the name of the game right here. So if we could see China open up, they can start producing again. That'll bring down inflation because we will have productivity in line and the supply chain in line. So that's a very long list. And for the most part, that's what we're taking a look at. So we are cautiously optimistic at this moment in time. I think we will see a recession in 2023. We are positioned, again, we've had some cash and now we're repositioning into treasuries for clients. The equities, the stocks that we own, we like them for the long term. So we're not going to be traders of those, even though they might be down this year, last year, year before, in previous years, they have been up and up significantly. So giving back a little bit for that growth is expected. So that's it. We're balanced, we're diversified, and we're keeping our head up for opportunities. That's our update for today. Thank you for watching, and we will see you again next time.